Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, September 13th, 2022. I'm your host, Will Pauly, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will.
Let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, well, last week we finally snapped a 3-week losing streak. We came back from the long holiday weekend, and we actually started off a little rough patch. We had a stronger than expected Services PMI, which came out on that Tuesday. It sent yields higher, and stocks kind of rolled over. But surprisingly, we had some hawkish comments actually from Fed Vice Chair Lael Brainard. She actually, she acknowledged the risks in over tightening, and for some reason the bulls took that as a sign that okay, maybe this is a dovish comment that the Federal Reserve is going to be striding about not going too far. And of course, the way this crazy market is right now, the market rallied on that. We saw yields move lower, despite the fact that she was saying that we're going to be bumping up rates higher for longer. The market's looking for any kind of reason to be optimistic about things right now, and it took off on that. We actually saw the indexes rally into Friday. Again, I guess it was. I said in the weekly comment, that it was kind of a mixed bag. However, despite the fact that we did see some, improvement in the technical condition of the market, the bounce off of towards the middle of the week was broad based. We saw every sector finish positive. We had more than 4% gains in let's see, Consumer Discretionary, materials, healthcare, financials, and REITs. They were all up very strong. And I'm not sure which was I think energy may have been the weakest sector, but still positive for the week. Okay, we even had two other Fed presidents come out midweek, and they again were saying, "Listen, we're going to keep rates higher for longer. We got to fight this inflation. We don't want to be seen as we need credibility that we're going to take this down to the mat." And again, we saw the yield inch lower a little bit. Then they kind of stabilized ahead of the weekend. We saw the U.S. dollar go down. The 10-year T-bill ended the week at around 331. We saw the 2-year Treasury landed around 357, which did see the yield curve narrow a little bit, but not much to really start thinking you need to start buying banks or anything quite yet. So crude oil prices tumbled early in the week on demand concerns if we were going to on higher rates, and then we saw oil turn around later in the week and fell to an 8-month low on Wednesday before firming again in the weekend. Now we had the CRB commodity index also fell to its lowest mark since February. Part of that is when the dollar gets stronger, you'll see commodity prices move lower, and that surprise doesn't happen right at that same day normally. We talk, the U.S. dollar has been strong all year long here, and we actually saw the dollar pull back just a little bit, but the commodity index started to roll over here probably about a month or so, a little bit. So maybe that'll help out going down the road of inflation. But anyway, we had a little bit of a 3-day spurt. That was enough to send the measure averages in the plus column for the week, and that was the first winning week we've had since mid-August. Now, I said the technical condition of the market did improve last week, but it's kind of a mixed bag because we're coming off very oversold levels. The market edge S&P short range oscillator hit 736, minus 736 on Tuesday, and when it gets below 7%, historically that's seen buyers coming into the market, and that's what happened. The underlying breadth was very bullish. And we saw the across the board, every sector was higher. We also saw some some bullish things on the charts. We saw the major averages are now in a higher highs and higher lows type pattern, and that's good for the market going forward. We also saw the S&P 500, the NASDAQ, and the Russell 2000 were able to clear resistance at their respective 50 and 100-day moving averages. That was another positive. Normally if you take out some key resistance levels, you're hoping you might get a little bit more of a push after that. But I did point out that we're still below the declining 200-day moving average, which means the long-term trend remains bearish. Now, the Dow Jones and Dow Jones Transportation Index did struggle at their resistance areas at that 50 and 100-day moving average. But I mentioned Friday that we could see positive momentum push those indexes above that key level to start the week, which we got yesterday. The different indicators currently they're going into the week today. They were basically kind of neutral. MACD was a short-term gauge. It was getting ready to cross in the bullish ground, I think, but it did for several indexes yesterday. So that was another bullish sign for the broader market. We did not see, we did see the Russell 2000, the semis outperform the broader market. Again, that's another positive last week. We like to see those secondary indexes lead the market higher and lower. So that just kind of backed up the sport that it got a lot of bulls saying, okay, maybe if we get a good CPI that shows prices coming down, then we're going to be set up for maybe another run towards towards the old highs that we had here back in August. Underlying breadth again was positive. The AD lines on the NYSE and NASDAQ were both showed strong accumulation across the board. We actually saw more new 52-week highs and new lows on the NYSE on Friday. That was the first time that's happened in several weeks. And then lastly, another sign that we saw was actually bullish for the market. We saw investor sentiment once again get up to those overly bearish levels, which could indicate the market's trying to put in a bottom. The American Association of Individual Investors survey showed that only 18.1% of retail investors are bullish, which means they're bullish over the market over the next, say, 6 months. The last time we saw it that low was when the market bottomed in June. So when some of these sentiment indicators, we more or less look at those when they reach extreme levels as a contrarian indicator. We also saw the pros get close to throwing the towel. The National Association of Active Investment Managers Exposure Index, which we follow, dropped all the way down to 27.3%. That's down from 71.6% just 4 weeks ago. So they've been taking some money off the table on this last little rally here. And again, at these levels, those are both considered contrarian indicators, meaning that when everybody's on one side of the trade, that we may see a bottom at that. Okay, on the comment, which I try to throw in at the end of the weekly letter, I talked a little bit about the market right now. It doesn't seem to believe the Federal Reserve that they're going to keep on raising rates into this environment. They think that the economy seems to be strong. They were expecting, obviously, a lot of people were expecting the CPI to show a drop in prices. A lot of that was due to the falling gasoline prices, and in some cases there was some food things that had gone down lower. But that food and energy aren't included in the core CPI, which is what the Federal Reserve focuses more on, that because the rest of the CPI, the core part, is not as volatile as you get when you're with energy and food prices. That's why they don't include those. So I mentioned that we had the CPI coming out today, and then we also have the PPI coming out tomorrow, and then we have a slew of economic data coming out on Thursday, which includes let me see, I just looked at this a little bit ago. On Thursday we get jobless claims, the Philly Fed Manufacturing Index, we have retail sales, we have the Empire State Manufacturing Index, import and export prices, industrial production, and business inventories, which will be the big. That's the majority of data that the Federal Reserve will have before they go into their meeting next Tuesday and Wednesday to talk about rates. And it just wants, you may look at this stuff and you can take it two ways. Now, if things are good, that's going to be bad news probably for the market, and the fact that that just means the Fed can keep their foot on the pedal a little bit longer, and they're not going to be worried. Now, if it comes in too good, you can see the possibly see the Fed swing the bat, hit and raise rates 1%. I don't think that's going to happen. Well, we could talk about that a little bit later. But also when you look in this, see some of that data, you're also going to get people saying, okay, well, it's maybe a little bit better than we thought it was going to be, the economic data coming in, and then that they're going to be saying that means that if we do go into a recession, that perhaps it's going to be a very shallow recession, and we're not close to it yet, and that could keep some of the sell-off in check. But as far as I think you still want to be cautious. I didn't know what the CPI was going to be. I know that on Friday the CME Group FedWatch tool was looking at probably a 90% probability of a 3/4 point hike in rates. That has actually we'll talk about that going further a little bit more. And I mentioned that okay, right, that could, the market is kind of expecting that right now. But what's going to happen if if they're kind of pricing in 3 3/4 to 4% top on rates, and now to today's CPI number, we may get a little bit. They may have to go higher. I think they're talking already now 4 1/4 or some of that. So I still think it's time to be cautious. We've been in a void on the market, bearish market posture since 8/26, and I think there's other things going on. We have a weak seasonality ahead. The latter part of September and into October historically has been pretty rough sledding for investors. So we have that coming up, and then again we're still raising rates into this while the Fed's calling for the economy to slow, and that if we get a bad PPI number tomorrow, we could see another secondary sell-off from more than today. But the way this crazy market is, and this would be because of the algorithms, you may get a number that maybe shows a little bit of a dip in PPI prices, and you can see this market jump up 400 or 500 points tomorrow. I would not be chasing that by any means. I think that would sell off pretty quickly. But it's not like the people on Wall Street are nuts and they're just loading up one day and selling everything off the next day. A lot of this, they're just going to push the algorithms show that if something is higher or lower than expected, it automatically kicks in a buy or sell program, and that's why you'll see these big swings off of this numbers. But right now, like I say, I would continue to be cautious on the market and take it from there.
The CPI seems to have somehow caught Wall Street by surprise. What do you have to say about that?
Well, I was a little bit surprised that it was as high as it was. I thought maybe we'd see a little bit of a tick down myself. I thought I saw the numbers, the market rallied into it. And I think people thought that even the core would come down a little bit, but it didn't. Now the headline inflation I think was down a little bit. It was 8.3, down from July's 8.5%. But for the month of July or for August, we jumped to plus 0.6%, and that was above the 0.3% expected. It was double what they thought it was going to be, and then year over year for August, it was up 6.3%, and that topped the 5.9% consensus that they also had out there. So when you had that, you've had 2 3/4 point rate hikes already, and you're hoping that you're going to start to see something in the numbers start to going to have some kind of effect on inflation. so far we're not seeing that across the board. And so the rates jumped up today. I think last I looked, we saw the 2-year T-bill hit a 14-year high. It was at 3.75%. The 10 years back above 3.5%. We saw the Dow Jones before that number was read. It was up 250 points, and now we're down. As I'm speaking here, we're down 940 points. So what's that? 1,200 point reversal in the market. Of course, with the higher rates, we saw the U.S. dollar go higher. A higher dollar makes commodities more expensive, so that'll hopefully help bring prices down at some point. But a strong U.S. dollar is not the best thing for the stock market, especially when you get some of these multinationals and it's things like Microsoft and Apple. That type. It's going to they have currency conversion risks, stuff like that. And as rates are still going on up, you're still going to struggle here with your big cap tech and growth stocks. So it wasn't a good thing for the market, and that's why you saw it. You see the thing down almost 1,000 points today.
So what do we watch for now in the market?
All right. Well, first off, I think that you're going to see the recession fears once again start to move back. I noticed I just mentioned a little bit ago that as of yesterday, yesterday I think it was 94% chance of probability on CME. FedWatch told that we were going to see a 3/4 point rate hike. Now, as of right now, that has actually gone down to 78%, and the reason being that all of a sudden, 72%. Now it was a 0% yesterday, but we're already up to a 28% probability that we could see the Fed hike rates 1%. I got to tell you, the market's not going to like that if they go 1%, because I think that's just going to. Some people they say it shows the Fed being aggressive. But I think that's an awful big hike in that. So that would be bad for the market. Now, over the last few weeks, as far as what to expect from here, what we want to watch, a lot of analysts, including myself, have talked about that we could see a revisit of the June lows. Some have already said the lows are in. We're not going to do that. And a couple of the things we've mentioned in the past is that when you see a market in a bear market, you see it end when maybe you see a washout. And I said that you don't always have to have that. It makes it a lot easier to see to tell where the bottom is. And we really didn't get that in June. So I think that now comes into play a little bit more, where you want to be aware of where we walk in one day and all of a sudden, we had this big sell-off. As of right now, despite this 1,000-point drop, the volume is, especially on the NYSE, is a little bit subdued. So this isn't like a washout day. You couldn't classify it as that, although the AD lines are really staggered. So I think that just in the back of your mind, you want to keep that going along. Also today, I was talking to someone earlier. When you have these washouts and stuff like that, you're going to see the VIX, the VIX, the VIX. You'll see them spike up when you're getting close to a bottom. I'm in shock today that the VIX is only up less than 2 points, and we're back at 25.86. That's not. The VIX isn't going to do that if this is going to be a washout day. This is just telling you that on that the traders are disappointed, but they're not throwing in the towel saying, I don't know what's going on. So the VIX is telling you right now that maybe, we kind of try to ramble around here sideways and maybe get some more information or wait till next week before we throw in the towel if that's what's going to happen. This is a 1,000-point day to see the VIX, only up less than 2 points is very. I'm not sure. I don't really get that, but I would expect to see the VIX up around in the 30s. So you want to look for that VIX to get up around 35, maybe even 45 on a big sell-off day before you start to jump in and say, hey, okay, I think this bottom is in. But let's see here. Well, I did have a couple other things I wanted to mention. I wanted you to watch for the different indexes. far as the Dow Jones goes, first thing we want to watch is last week's low, and that's 31,048. Right now, it's 31,412. So we actually have the Dow could go down, another 350 points just to get to last Thursday's low. That's going to be the first test of real support. If it doesn't hold that, then you can probably ink in the June lows. But yesterday we did see the major averages cross above their 50 and 100-day moving average, which was good. We've taken all that out here today. But another caveat is that the Dow sell-off today so far has stopped at about the 61.8% retracement from the June to August rally. Okay, that comes in right at around 31,480, 31.5. So we're actually going below that right now. But it'd be interesting to see if the Dow can close above, say, 31.5. That would be actually a little bit of a positive, and say that, okay, well, maybe this is it. This is where we're gonna maybe try to find the bottom in here, and we won't retest that lows. As far as the S&P 500 goes, last week's bottom was 38.86, and right now we're at 39.73. So we're about 90 points above last Thursday's low. So that's something you want to stop and think about. Now, the S&P 500 last Thursday, it actually went down to the 61.8% Fibonacci retracement, and that's where it bounced. Okay, today's sell-off actually has found support at the 50% retracement level of that June to August rally. That's somewhere around 39.94,000. We are below that now, but if we can maybe get a rally towards the end of the day that trades above, that keeps the S&P 500 above 39.94,000, I would say that would be a positive, which would mean that okay, maybe we're not going to go down and test that June lows. But for right now, you want to keep a number on that. Finally, with the NASDAQ, last week's low was 11,471, and currently we're at we're down almost 4.25%. We're at 11,751. So the NASDAQ still has a little bit of can take a little bit more selling before it gets to where it bounced last week, and that also bounced off of its 61.8% retracement of the whole June to August rally. So watch those first. If we somehow get to those last week's lows and we try to bounce around there, then I would feel more confident saying that probably we may be able to go sideways here and actually get a little bit of a bounce. I'm not buying it yet, especially you also want to watch the VIX. They don't seem to be too scared yet that we're going to break down to that. Like I say, with the VIX in the mid-20s, that's to me that's just a little bit of a. I'm not sure why they're not a little bit more nervous about that. Another thing I also often talk about, I want to watch the secondary indexes. The Russell 2000, the Dow Jones Transports, and the Philly Semiconductor. If you look at the SOX, the semi index, you can go ahead and pull that up, Will, if you want to. We've got a big gap down today. We're almost at the lows from last Thursday on this thing, where we can see where we gap down. With that gap down, this is a horrible looking chart. It's still making lower highs. We did make a higher low, but like I said, I think we're about ready to make it. I think you're going to take out last lows on the semis. It's getting hit pretty hard today, and as of right now, it's down 5% today. Nvidia, all these big semiconductor companies are just getting hammered. 5% drop is they're kind of getting close to throwing in the towel on that. So that could lead the market down. The Russell 2000 also is selling off more than the broader market. It's down 3.5% right now. The transports are down over 3% too. Now the NASDAQ is down 4%, but that's mainly because the big tech stocks that are overbalanced. They have more of a weighting on the NASDAQ, especially the QQQs, the NASDAQ 100. Those big cap tech stocks make it go up faster, but they also make it go down more. Just to wrap it up here real quick, Will. I've heard a lot of people on the TV saying to buy the dips when you see in here, and you're going to have people coming on today saying, hey, this, the economy's strong. This would be a dip to buy. I still think you need to be patient here for several reasons that I mentioned. The seasonality, and also just the we're still raising the rates, and we're not seeing a slowing down in in inflation yet. A lot of these big stocks that you may be looking at, some of them are down 50 to 80%. So you're going to have time to get into these things and still have a decent price. But a lot of these, you're not going to recover those losses for several years. So you have time to buy. I would pull up a second opinion on some of these stocks which you're looking to buy. When you start to see some improving technical conditions, maybe then you nibble away. But lastly, as far as like a V-shaped recovery, I would see on some of these stock indexes, when you get to you're going to get up here around 4.25%, 5% on corporate bonds. So if I'm retired or I'm an investor who especially has gone through some of these wild swings the last 3, 4, 5, 4 years or whatever here, if I can now get a 5 or 6% risk-free by buying some corporate bonds, I'm not going to put all my money back into stocks. You've seen this thing where if you've been in stocks and bonds for the last several years, you've probably lost money a little bit on some of that. But older investors, they've had to buy stocks here just to get the dividends to supplement their income. But again, if they can get 5 or 6% here, risk-free with the bonds, they're going to start moving more of the retirement funds into that, and that's going to limit some of your stock market returns over the next couple of years, because it's going to be a lot of money that would have gone back into stocks is not going to go back in. That's going to keep you back to the historical levels where you often read about where you start to see the historical levels on the S&P 500. You get a 7 or 8 or 9% return. I think that's going to be more, again, once again, the average here going forward, due mainly because of people going more into bonds later on. There's going to be less money chasing the equities once they start to bounce back. And if you think about that, if you've only been in the market a few years, you've never seen the kind of people invest where they allocate, say, 50 or 50% of their money into bonds and 50% into stock. And that's a lot of money out there that again won't be chasing equities on this go around as the Fed keeps raising rates. So be aware of that. Don't expect some of these things to go if they're down 80%. You're not going to get back up there anytime soon. So at this stage, I think I would just be cautious. Take your time. I don't think there's you're not going to miss much of a bounce in here, because there's going to be a lot of people also trying to get out of the market to go into maybe some bonds as we start to see some of these bounces. So be patient and kind of watch this thing and watch those levels that we just talked about, which are mainly last week's lows from Thursday. Maybe we might try to hold that. That would be nice. But if we don't hold those, then you can go ahead and ink in a retest of the June lows, and we'll see if that holds.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.